Did you know that retirees' number one fear in retirement is running out of money? People are actually more worried about running out of money than they are of dying. In today's video, I'm going to explain the number one threat to your retirement portfolio and 8 ways to protect against it. Hi, if we haven't met yet, I'm Trevor Johnson, founder of Dreamweaver Financial Planning. I help hardworking savers who are in or near retirement create a financial plan that turns their savings into financial freedom. The number one risk to your portfolio in retirement is called sequence of return risk. And in simple terms, what it means is that your investments perform poorly in the first few years of your retirement. I'm going to give you a quick example of how sequence of return risk works, and then most importantly, I'll go over 8 ways to guard against it. So in this example, both retirees start with $1 million and they're going to withdraw 5% a year. So the first investor has a bad first year, so their investments go down 20%. The second year, it's 0%, and then in the third year, their investments go up 20%. Now, the second retiree, they have a great first year, their investments go up 20%. The second year, 0%, and then in the third year, they lose 20%. Now, if we project out how long their money lasts, well, the investor that lost 20% in their first year, their money runs out in 16 years. Now, the investor that made 20% in the first year, their money is going to last for 20 years in this situation. So they both had the same average return. In this case, the 3 years would average out to 0%. However, the one that had the good first year, they got 4 more years out of their money. There's 4 key takeaways from this example. The first is, it's not the average return that matters, it's the order of the returns that matter. The second is that sequence of return risk is most dangerous at the start of your retirement. The third is that withdrawals make sequence of return risk magnified. If you have to take money out when things are down, it's even worse. And the fourth is that reversing the sequence of returns changes everything. If you retire into a bull market and your investments are doing really well in the first few years, there's a good chance that your money is going to last a lot longer. So how do we manage sequence of return risk? How do we protect against poor investment returns in the first few years of our retirement? The first approach is to use the bucket strategy. And in this strategy, what you do is you put your money into 3 different buckets. You have a short-term bucket, a medium-term bucket, and a long-term bucket. So in the short-term bucket, you would have things like cash and cash reserves. And that would be for money that you need in the next, say, 1 to 3 years. The second bucket would have medium risk investments. So maybe intermediate term bonds, some conservative stocks maybe. And then in the third bucket, that would be long-term money. So that would be investments that are primarily made up of stocks. And this would guard against sequence of return risk because if the market goes down, if the stock market goes down, what you would do is you would pull money from that first bucket, from your cash reserves. That way, your long-term investments would have time to recover. The second way to guard against sequence of return risk in retirement is to start your retirement with a reasonable withdrawal rate. And what I mean by this is we've all heard so much about the 4% rule. So if somebody were to say, I'm starting my retirement with a withdrawal rate of, say, 4% of my portfolio per year, I would say that's a good conservative withdrawal rate. If someone said, okay, it's 5%, I think that's reasonable as well. However, if someone said, I'm withdrawing 12% of my portfolio per year or 20% per year, the odds of a portfolio like that lasting throughout your whole retirement are pretty slim, especially if in the first few years your investments perform poorly. The third way is to use what are called dynamic withdrawal rates in your retirement. So if you start your retirement and your calculations are based on taking 4% a year out of your portfolio to live off of, if the market performs very poorly in the first year or two, then try to take out less than 4%. So maybe you take out 2% or 3%. But the idea is if markets are down, you want to take as little out of your portfolio as possible while they're down. Now, if you do use the 4% rule for the basis of your retirement planning, just know that the 4% rule really was based on the worst case scenario. So if you couldn't afford to take less than 4% out of your portfolio per year, you probably still would be okay taking the 4% out. But if you did have the wiggle room to take out less than 4% when the markets were down, it'd probably help you sleep better at night, and it would definitely make sure that your money lasted longer in your retirement. The fourth way to guard against sequence of return risk in retirement is to consider taking a portion of your portfolio and setting up an annuity that would provide a monthly check for the rest of your life. Now, I know annuities are not for everyone. There's some situations where they make sense, and there's some situations where they don't make sense. But an annuity is a tool that guards against sequence of return risk. An annuity protects against sequence of return risk because it's not tied to the stock market. Your monthly check that you'll receive for life will not change no matter what the market does. So if there's a few negative years at the beginning of your retirement, it doesn't really matter because your check will be the same every month. The fifth way to protect against sequence of return risk is to consider delaying your Social Security benefit until age 70. So let's say you're retired at age 65 and you were living off your investment portfolio, and let's say the market had poor returns from age 65 to age 70. Well, while you were living off your investment portfolio, your Social Security benefit would have been growing each year. So now at age 70, Social Security kicks in and you don't need to rely on your portfolio as much. You can rely more on your larger Social Security benefit. The sixth way to protect against sequence of return risk is to build a sufficient cash reserve for your retirement. Some people like to have between 1 and 3 years in cash. So if the market goes down, they just draw from the cash and live off of it while the market recovers, while they wait for the market to recover. So the average mild bear market, where the market goes down between 20 and 30%, that takes 1 to 2 years to pass. The average severe bear market, where the market goes down 40% plus, that takes an average of 3 to 6 years to pass. So that just gives you a rough idea of how much cash to have. So if you have between 1 and 3 years, you'd probably be okay. But if you're a very conservative retiree, then maybe having between 3 and 6 years in cash would help you sleep at night, just in case you have a poor sequence of returns when you retire. And just to clarify, when I say cash, I don't mean paper cash. I'm referring to short-term treasuries, the money market, or like a high-yield savings account. The seventh way to guard against it is to make your asset allocation a little bit more conservative as you approach and start retirement. So all this means is that you would make the percentage that you have in bonds or in safe assets slightly higher. That way, if the market does perform poorly right as you retire, you don't lose the majority of your savings. You don't want to make your asset allocation too conservative, however, because if you make it too safe, then you're going to sacrifice the potential for long-term gains. The eighth way to guard against sequence of return risk is to use what's called the 10-year rule. So this is kind of a combination of what we've already talked about, but this is a different way to frame it. And what it means is just very simply, don't put any money in the stock market that you'll need in less than 10 years from the point that you retire. If you are looking for a financial planner that can help you build a portfolio that can handle sequence of return risk and help you navigate the markets, please reach out to me directly using the link below. Thanks for watching, and I'll see you next time.